Hi, welcome to the partnership accounts tutorials number 8. What I've done on this one is the answer is over here. Quick, go back. Don't want to see it too quick, do you? But by all means, have a go at this. Stop video, then watch me through, and maybe I'll mention a couple other points that you might want to stop. Okay, straightforward question. But this time I focus more on the balance sheet because I haven't done that up till now. All right, so here we got ABC partnership consisting of partners A and B. Kept it relatively short now. They're preparing their balance sheet at the end of the year, and the partner's trial balance, well, not really a trial balance in the conventional sense, but anyway, we've got the following account balances. So you can assume it is trial balance figures. They will balance if you put them on the debit credit side. Okay, so what have we got? We've got cash, accounts receivable, inventory. So what we've got some assets here, equipment, more equipment. It's actually not 50,000. I've changed the figure. Accumulated depreciation, accounts payable, loan payable. So here we've now got the depreciation, quite an important figure, affects your assets and your profit for that matter. Accounts payable, loan payable. So we've got a couple of liabilities there. Capital accounts and a net income. Okay. So starting with I want the assets on this side on the left, and then I want to end up with the net assets. So I just want you to understand my thinking first. And here I'm going to put financed by. So financed by will consider long-term liabilities and owner's equity. Now, in this case, the owner's equity will consist of the partner's capital accounts. Let's start off with the assets of the business. So what do we have? Well, we start with our fixed assets. Right, well, we looking across here, we've got the equipment. So there's our equipment. And that has a value of cost at 72. Now then, we have got to take off that the accumulated depreciation off, because what we're looking for is the value of the assets net of depreciation. So that figure is over here. I'm going to put it in red. More conventional sheets may be to put them in brackets rather than red. So what I'm going to do now is take the assets, deduct the accumulated depreciation. 72 minus 8 gives us 64, and that now becomes the value of fixed assets net depreciation. Okay, next section, we want the current assets. Now, again, looking across, get a grip of this. We've got the cash, accounts receivable, and the inventory. We've got the cash, and we've got those other two. They're all current assets. So the cash, we've got 24,000, and a little bit of artificial intelligence there tells me that probably these two need coming across as well. Right, add them up. So I'm going to sum them. 3 to give me the sum of the current assets, so 67,000. Okay, current liabilities. Now this will be money that we owe within a financial year, 1 year or less. And looking across there, we've only got the accounts payable. And now I'm assuming that loan payable is long term. So I'm not going to put it in as a current liability. It wouldn't be the end of the world if you did, because you will still end up with a correct balance sheet technically. Okay. Accounts payable, that was 11,000. There's no other, so I'm actually going to put it under there, just tidy it up. So I've got working capital. There's current assets less current liability. So there's my 2 assets. Fixed assets up here. Current assets down here. Less current liabilities. In other words, working capital. Now, when you add the 2 together, lo and behold, we get our net assets. Now, that is the worth of the business after it's paid its immediate debt. That's what the business, technically speaking, should be worth. So we want to see, well, how is that reflected in the finance bisection? Well, the gearing of a company will be between its loan capital and what the owners have invested in it. So let's start with the loan capital. And that is in the form of the loan payable. I've got that figure way over here. Loan capital being 30,000. So what I'm left with now is, well, what do the partners own? Oh, it's doing it all for me. Isn't it? I'm not going to make it that easy for me. So the partners B capital is there, but of course the net income is also part of what that belongs to the owners. Very important. That's the same as with the sole trader. But with the sole trader, its profit is the personal income of the owner. Whereas with the partner, we've got to decide who gets what. But anyway, the capital accounts, these are the closing figures anyway, 40,000. So the 2 figures I'll get the computer to help me out there. So there it is. The little neat boxes. So right, what we've now got is the 3 capital owned. That now is in fact the owner's equity. That is the owner's equity. So let's say so. The owner's equity is in fact those 3 figures added together. So again, that's a sum. Add the 3 together, 90,000. So with the owner's equity, along with the long-term capital, we add those 2 figures together and we get 120,000. So the net assets down here, let's highlight that, make a big point of that, is 120,000, and that's reconciled with this figure, 120,000 as well. So this is what the business is worth. That's how it's financed. Here we are. End of that question. And I'll be back in question number 9.